All right. As it was asked earlier if this is being recorded, and yes, it is. So I just want to give that heads up to everybody. And let's see. We're going to go ahead and get in here. And my apologies. One would think that I was maybe a little bit better at. There we go. From beginning. That's it. All right. Okay. So let's go ahead and get started. Thank you again so much for being here. And I just want to, sorry, I'm just admitting everybody in. Great. Having so many people is a good problem to have. Just want to go ahead and thank everyone today for joining in our webinar, An Introduction to the C Market. As a bit of housekeeping, we have quite a few people here who are tuning in from all over the world. And I'd like to just ask that everyone keep their microphones on mute if I could. If you have any questions, please type them in to the chat window. At the very end of the presentation, we'll go back through and try to answer as many of those questions as we can. If your question doesn't get answered, please feel free to send me an email, and I will be very happy to follow up and get that answer to you as soon as possible. Okay, with all that said, I think we're ready to get started. Let the rest of the people in. Okay. So I think we're ready to get started with our content today. Again, thank you so much for joining. This presentation is brought to you today by Novus Coffee Imports and Mercon. I'd love to give a real brief introduction for everyone to Novus. So Novus is a full-service specialty coffee importer based in Seattle, Washington. We focus on coffees that engage farmers through empowering projects and relationships that bring lasting change for farming communities. Novus is the specialty arm of Mercon, and Mercon is based in Nicaragua with a U.S. trading office in Miami. For over 65 years, Mercon has supported farmer sustainability through unique and innovative grassroots programs that address the true economic success, or what's needed for true economic success and longevity for farms all over Central America. So, I'll give you a brief introduction to myself. My name's Emily Smith. I do green coffee sales for Novus Coffee Imports. I am based in the Pacific Northwest, not Seattle, but Portland. And I come from the retail and roasting side of coffee, former head coffee roaster and green buyer. I am a licensed Q grader and one of your community directors for the SCA US chapter. So it's great to be here. I'll just note that there's something I did not add on to that list, which is market expert, which is why I have my colleague Joshua here. Joshua is with Mercon, and Josh, I'm going to turn it over to you to give a little introduction. Josh is going to be popping in throughout the presentation to add context and provide additional information, answer those tricky questions. So, Josh,
Sure.
you want to go ahead?
Yeah, thank you, Emily. So before joining Mercon, fortunately or unfortunately, I was in the mainstream coffee business. So I was at Kraft Foods for 9 years. They've got the, I guess you could call the legacy brands, Maxwell House. They had the McDonald's business at the retail stores. They started Tassimo, the single serve which was before K-Cup, but K-Cup eventually overtook them.
I had a Tassimo brewer. I just want you to know that.
Yeah, yeah.
I did.
It's big in Canada and Europe, but not in the US, obviously. But really, my background is on commodities risk management. I did lots of different commodities at Kraft, dairy, sugar, corn, coffee, and energies, crude oil, gasoline, heating oil. Then 4 years ago, I joined Mercon. I lead the trading, derivatives trading, as well as risk management and the Colombian diff book. So please don't be shy about asking any questions about the markets, and hopefully we can answer all of them.
And if you have questions for Joshua throughout this that are not able to be answered, I just want to encourage you to shoot me an email. It's esmith@novuscoffee.com, and I will make sure to get your questions over to the correct people so that we can get your questions answered, okay? We have a lot of content, so we're going to dive right into it and hopefully respect everybody's time commitments for the day. So I wanted to start a little bit with some learning objectives. I want to make sure to be clear with everybody about what we're going to cover, and in particular, kind of what we're not going to cover while we discuss this introduction to the C market. So first, we're going to talk about what is the C market. How does the C market function on a very basic level? We will be touching on some key terminology. I've got some different terms throughout that are highlighted or that are in bold. So if you're taking notes, I think those words in bold are probably great ones to jot down. And then Joshua's going to give us a little bit of information, some projections about what he is seeing in the future for the C market to help provide some context to the information that we have just covered. We're also going to discuss a little bit of an alternative idea for risk management at origin and how Mercon and Novus see that. One last thing that I would like to just point out, this is a very informational, foundational little webinar, little introductory class. What we're not going to touch on is some of the ethics around C market pricing or any of that. This is really to give you an idea of how things function and the mechanics of what's going on. Familiarize yourself with terms that you might see as you're looking at information. How you want to take that information and go out into the world and use it is totally up to you. This is just really about providing some foundational information for everybody to help you get a nice little basis of knowledge as you venture out as a coffee professional. All right, so let's start with what is the C market? First, let's discuss the term commodity. A commodity is a physically traded good. It's divided into different sections. You have hard commodities, which include natural resources that can be mined or extracted, and also soft commodities, which include agricultural products, corn, wheat, sugar, soybeans, coffee. So coffee is in there. And those are traded on the commodity market, in commodity markets, which are physical and virtual marketplaces where it's traded, and where these contracts for units of whatever commodity are traded. Arabica coffee is traded under the New York Board of Trade. I think, Josh, is it with ICE? ICE?
Yeah, so that
Okay.
was the old exchange. It was eventually taken over by the ICE.
Okay, cool. So you'll see the term ICE next to it when you look at it online. Just to give you context, that's where it's traded. And it's under the label KC. To to let you know, so that's how Arabica is traded. Robusta is traded on the London market under LRC, and we're just going to be discussing the Arabica. So if you want more information on how Robusta is traded, go ahead and shoot me an email. If we get enough people interested in that, we might be able to put something together to provide some additional information for you. All right. And throughout this, Josh, just jump in, and if there's any spots where you want to add some information, by all means jump in, and I appreciate all of your knowledge.
Sure, sounds good.
So how is the coffee commodity traded? So it's a physical market. Well, there's a physical market, and that is traded in lots of 37,500 pounds, and it's traded in cents per pound. So you're going to see numbers that look like 94, or if you saw 100, what that means is 100 cents per pound, which would be $1. And it's traded in US cents per pound. Coffee is a physically settled commodity, although it's only a negligible amount that's actually physically settled. And what that means is that in coffee trading, there's actually people who are turning over 37,500 pounds of coffee in a physical manner at a warehouse. And there are people who are taking possession of that. There's a whole process by which coffee is graded, and it's determined how much that coffee is worth to be physically settled and traded in that manner. And Josh, those are certified stocks, right?
Correct. Those
Awesome.
are certified stocks.
Perfect.
The thing I would add, so when Emily is saying it's physically settled, so if you paint a scenario, let's say I buy one futures lot of Arabica futures, each terminal month, what they call, so let's say you're buying July futures, there's a deadline. It's called first notice date. So if you bought futures, so you're long the futures, and you go past that first notice date, then the exchange may call you and say, okay, we see that you're long on futures lot. You need to take delivery of that one lot, which is equivalent to 37,500 pounds at this port, or at this port.
Yeah, it's probably a call that most speculators don't want to hear. Right. Come pick up your coffee.
So the speculators, they typically do not touch the physical coffee, although they very much play and speculate in the physical, in the futures market and options markets. They rarely ever take physical delivery of the coffee. So they'll just roll the position to the next open futures contract. So if they're in July, they'll go into SEP before they have to actually take physical delivery of the coffee.
Yeah, and if that's kind of confusing for everybody, we're going to get in a little bit more to that, into what it looks like on the futures side. Again, if you have questions, jot them down or send an email to me afterwards, and we'll try to answer them as best as we can. It's super complicated. When I started learning this, I kind of had to come to terms with the fact that the people who know this really well, they have like degrees in it. And I'm a coffee roaster, so that wasn't exactly what I had a degree in. But we're really happy to provide this information for you. So as kind of going back to the presentation, that physical delivery of an exchange grade beans happens at a designated warehouse or port, and the spot price reflects the nearest futures trading position. All right. So we've talked about things kind of on the physical side, and then there's the other part that is really big, which is coffee being traded for future delivery. So those are the futures. And Josh, could you explain just a little bit in a super kind of basic way what that futures market looks like for coffee?
In what sense?
So the coffee is being traded for future delivery, and you kind of touched on it. People are buying contracts in the future that they're never going to take actual possession of the coffee. They're going to hold on to that contract and then sell it, right? So maybe just correct me if I'm wrong. They're going to hold on to that contract that they buy, and then they're going to sell it right at the very kind of last minute and get something that's a little bit further out or in the future, right?
Correct. So, so if a speculator is long coffee, or they bought futures before it gets the first notice, but they want to keep the position open, you still have to close out let's say July futures, but then they go ahead and buy September futures, so they keep their long position on. But if I take a step back, futures market for most coffee companies, users, roasters, is kind of this universal base price for coffee. So as it ebbs and flows and moves almost every second during the trading day, it really is the international baseline price for coffee. And then you get into differentials based on quality, based on origin, um, based on certification, all these other things that differentiate the coffee. It's plus or minus that base futures price. So
Right.
although a fancy Way Tenango from Guatemala may be much more expensive, it still is a base price of wherever the futures price is.
Yeah.
And then the delivery periods are useful because, let's say it's only June, but I want coffee in November. So I'm buying forward. I haven't taken a physical coffee yet, but I know I'm going to take it in November. It's going to be priced against December futures.
Yep. And we're gonna cover a little bit of kind of why those. So each of these little spots in here for delivery periods. So these are the recognized delivery periods. So when Josh says that, Josh, what's the term again for the very the last day that
First notice date.
First notice day, sorry. So on the first notice day, there's going to be a first notice day and like right before the end of March. So people are trading January through March, and then at the kind of right before the end of March, there's this day where everything has to be kind of finalized. What's important to know is if you're looking at a coffee and you might see that it's priced against July, but you're looking at it maybe in June, it might be a little bit confusing as to why they're using the term July regarding that June price. It's because it falls into this section right here. So June and July are part of this delivery period. So I hope that makes sense to everybody. Likewise, if you are looking for coffee in February or in January, it'll be priced with that March, right?
Yeah.
So
Correct.
so
So, sorry. So let's say March. The first notice period is usually in the previous month.
oh, okay.
So by February, you got to get out of March.
Yeah.
And let's say July futures, you got to get out by early June.
Perfect.
But even for, let's say, a third wave roaster or specialty, they're not buying it on differential. They're just buying flat price because the coffee is that
Yep.
good. In the background, as we try to source the coffee, it may be still based on a universal base price, which is where futures are, and then we have to pay a differential, but ultimately we sell it at price to the roaster or the client.
Yeah. So I wanted to show a little bit of kind of what that all looks like in a context that you may be familiar with. So you may have seen, as coffee roasters, you may have seen something that looks a little bit like this, which can be super confusing, okay? So I just want to break it down for you and explain what these different pieces mean so that you can kind of decode it when you may be looking at pricing or any sort of quotes that are happening, or even just trying to follow it along on the internet to see where the market's moving. So KC, that's our market name, so that tells you that it's Arabica coffee. N is going to be the delivery period month. So you'd come over to here and see that N corresponds with July. If you can't remember these, which I absolutely can't, you can go online and just search for delivery periods for coffee, and you'll see a lot of websites that'll give you this information to what the codes are so that you can make sense of that. Next one on here is going to be 20, which is your delivery period year. So from that, we can see that this pricing is Arabica coffee for the period of July of 2020. And then here, we're going to see the price in US cents per pound, often abbreviated by USC. And so we see it's 96.42. These numbers oftentimes will go to 2 decimal spots. So you'll see like 96.42, and that tells you that it's 96 cents per pound. 96.42 cents per pound. When you're talking loads and loads of coffee, those little bits at the end over here, that 0.42 adds up when you're looking at 37,500 pounds of coffee. So it can be important. All right. So let's actually see what it looks like. I pulled this off of a website called Bar Chart yesterday. So we can go through this together. So here we have I think I have it written over here. So we have coffee price for delivery period of July 2020. And here we have the price in US cents, as well as how it has changed. Previous day's closing. This is really important because even though you might be asking for a price on a coffee and you're asking on this day, you might get a quote that marks this. So like if you were to look online, you say, oh, it looks like it's 94 cents, but then you go on to, but the quote that or the price that was given to you was listed at 96. So because there's volatility just throughout the day, the previous day's close is oftentimes used for when we write out a contract or give some sort of pricing. And then here we have a little graph of kind of where the trend of the prices is. So you can kind of see this is over a period of 3 months, and you can see the activity that coffee has had during the day. So greens are going up, little red ticks are where it was going down, and you can see a little kind of what the trend looks like. I wanted to point this out because the next page we're going to look at is going to look at let's go right over to it. So this is what coffee looks like if you're looking at many different delivery periods. And it's okay. So, so one thing when I was learning about the market that that was a little bit confusing to me, and other people I thought may have the same sort of question. If coffee prices are trending down, why does the September price, actually September would be like here, why does the September price cost more than the July price? So the reason for that, even if there's a trend in the price that maybe it's going down or maybe it's going up, but the reason that September will cost more is because of contango, or a term you may be more familiar with, carry. So contango or carry is the financial incentive for investors to cover the cost of finance, warehousing, and insuring the coffee stock. So I think this is something that roasters are very familiar with. And it's good to know that it's also reflected in the market pricings as well. If you are looking for a coffee to be delivered in December, we're going to look, or let's say October, we're going to look at this December price because in between now and October, there are certain financial costs that the trading house is going to incur to lock up that coffee for you and to manage the cost of the finance and any other associated fees. And that is reflected by how this is different. Anything you want to add, Josh? Does that sound all right?
Yeah, there's the carry or the premium. The further out you go, it's one of the more complex things to understand because there's all kinds of spread trading involved with this, as well as when prices rally, it can become what they call backwardated, so it's the reverse. So that I think everyone understands this. This is as if someone took a snapshot of where prices are today. So you can see on spot, it's 95 cents today. But if I wanted to buy something, let's say in July of 2022 today, I'm just locking that price in down the line, but it's still today. It's at, call it $1.11 per pound. So there's a pretty steep premium farther out I go if I want to buy coffee far forward. And that's what the futures market kind of embeds, and it gives you that price indication that, okay, if you want to take coffee today, it's 95 cents. But if you want it in July of 2022, it's going to be $1.11.
Yeah, thank you. So we've talked a little bit about the market, some basics of how it's functioning, how the prices are looking. And the next thing that we're going to touch on is who's participating in the market. So you have commercial or industrial producers. They may be holding physical assets of the commodity or might actually need some of the tendered commodity. And they also might be in a position, most likely, where they're using the market to hedge against price changes and to manage the risk that comes with producing and moving coffee. The other group, so these are really like, this is your coffee industry people, right? So we have coffee industry people who are in the coffee market, which makes sense. But there's another group of people who are also in the coffee market, and those are speculators. They do not have any physical commodity assets, and they really don't want them. They also, their goal is that they're attempting to make a profit from price changes within the market. So it's good to know, it's really important to know that both groups are there. All right. The next thing that I wanted to cover is a very, very kind of basic understanding of what hedging is. So hedging is done by performing the offsetting or opposite action within the same market under similar terms. So it's either buying or selling, kind of doing this opposite action and using that to minimize risk. And common risks mitigated with hedging. So you can reduce the risk of rising prices. An exporter or trader that has committed to supplying coffee before the coffee is physically available, that exporter is short on the coffee. They've promised coffee that they don't physically have. So they might be doing hedging to minimize the risk on that the prices are going to rise. And then the other side of it is minimizing the risk of falling prices. So when somebody has physical has the coffee, they might want to hedge in order to, so they're long on the coffee. They have more maybe than they have actually sold or delivered or accepted payment for. And so what they're doing is they're trying to minimize the risk of if prices fall on that coffee that they've just bought. So doing those opposite sort of actions. Joshua, can you tell me, with if an exporter is short on physical coffee, what is the opposite action that they would do for hedging?
Ooh, okay.
In a very basic way.
I think it might be easier if we look at it from a roaster perspective.
Sure. Yeah. Thank you.
So if we're a large coffee company, multi-million-dollar budget, and we see where coffee prices are trading, at least the base futures price. So today, September, is at 96 cents. And we believe that, okay, 96 cents, it fits our budget. We can price at retail, make the margin for our budget. Let's just lock in 96 cents, because if we don't lock it in 6 months, it could be at 120, 130, and it can just blow through our budget. So for us, we just want to lock in 96 cents. And that's where they would step in and hedge the market. So they would just buy futures so that they can lock in 96 cents per pound for their coffee. The other piece of that, obviously, is which specific coffee they buy. So every origin has a different differential range, but at least you're locking in that base price for all their coffee. And then you can decide to lock in the differential price at a later date. So if you are right, 96 cents happens to be the bottom, you lock in, let's say, 6 months worth of coverage. So no matter how high the futures market goes, doesn't matter. You're financially set at 96 cents. And now you just go out and buy your individual origins. And typically it's an inverse relationship. So as the futures market goes up, the differential price goes down. So it's kind of a double win. If you can lock in early, the futures market goes up, the differentials that you eventually lock in, let's say for Brazil, it should come down, theoretically. So then you locked in a low futures price, and then later down the road, you're locking in a cheaper differential price. And one thing that your clients might be interested in, every Friday afternoon, the CFTC, they put out a public report. Is called the Commitment of Traders Report, and all the commodities. So obviously coffee is in there, and it's broken out into different subsets. And one is the commercials. So Emily talked about it on the previous slide. The commercials are the folks that are typically physically actually using coffee. So on the long side, those are the roasters. On the short side, those are the producers. So the industry is really keyed in on the long commercial number, and we can provide a chart just to show you how that has changed. But it really gives a good insight into globally what are the big roasters thinking. If prices keep coming down, typically they increase their coverage, and you can see it in the weekly report where that gross long position keeps getting bigger and bigger because they think these are advantageous prices. It may not last long. It fits their budget. So it's nice to see that weekly change, and it lets you know, okay, what are the big players in the coffee market, big global players? Are they increasing their coverage at current prices, or are they eroding their coverage, which means that at least they believe as a body that prices may come down. So it's just an interesting perspective, and I think it provides a nice proxy as to what the roasters are thinking and what they're doing.
And I think that there's also, for small roasters who are thinking, I'm not buying containers of coffee, I don't really, I'm not really involved in the C market at all. One of the things that I would just point out is that a lot of this hedging is happening behind the scenes to help finance for the next year's harvest, and to help companies be able to provide resources to farmers. You know, they're kind of in a protective spot. So it is part of what's happening and how we kind of it's kind of like the circle of life of how we keep things moving and going. So it may not be something that you're doing, like you're not buying or selling to offset your supply, but it might be something that a trading house is doing kind of in the background to help provide some liquidity or help to like just kind of make things move and be able to operate and do the functions that they need to do to make coffee happen for you. So it's kind of like one of those seamless in the background sorts of things that you may not see, but it's really important. Okay. So what the heck makes the coffee market move? We have seen all sorts of volatility over the last, you know, couple years, right? And so Josh, I'm going to kind of pass this over to you a little bit. You did such a wonderful job talking to me about this yesterday. So what factors affect the coffee market moving? So the first one that we had put up here is supply, right? So we've got forecasts for upcoming production and harvest, and also certified stock levels. As somebody who's involved with on the trading side and the risks, what do you look for with supply to give you kind of in a very basic way, what are you looking for with supply to think about how that market's moving?
Yeah, so when it comes to supply and demand, that's called, I mean, it's really what you would normally think, okay, those are the fundamentals that drive this market or should drive this market. If production is up, prices should go down. If demand is up, prices should go up. Inventory level, things like that, where it's just basic supply and demand, it should move prices. I think in previous years, fundamentals played a much bigger role in how prices move. We've kind of evolved to this place where the large speculators who don't touch coffee, they don't roast coffee, they don't produce coffee, they don't own any farms. They're really just speculating on many different commodity markets, but unfortunately, or fortunately, they provide liquidity. It moves prices erratically, and volatility increases. So we're moving away where prices can become disjointed from fundamental supply and demand. There's other factors, but of course, thematically, prices should gravitate towards fair value based on supply and demand. But not to deviate too much, production forecast is really important. And I guess a good parallel is when we think of crude oil prices. If anything major happens in Saudi Arabia, you see crude oil prices move. The same with the Arabica market. Brazil is the Saudi Arabia of Arabica coffee. So any kind of big weather event, currency change,
We're going to get to that.
Supply chain risks.
Yeah, that's the next one. You mentioned currency change. Can you give us a real basic on how that the Brazilian real affects the market?
Yeah, so I think it's twofold. Since the world is so focused on the commercialization activity on the ground in Brazil, from a Brazilian farmer's perspective, they don't really care where coffee is in US dollars or in that regard. If the Brazilian currency weakens significantly against the US dollar, in their mind, they're seeing the price in reals increase to them. So when they sell coffee, they're getting a lot more reals, and that's based on just the currency. So as the Brazilian real weakens versus the US dollar, the Brazilian farmer is seeing an increase in price in their local currency, and they sell more, and that provides more selling pressure to the futures market. And vice versa, if the Brazilian real is getting stronger versus the US dollar, they're going to see the sales price of their coffee decrease in their local currency. So then they'll pull back from selling, and then you have kind of this imbalance of maybe selling dries up and then prices kind of gravitate higher. So that's a direct correlation in terms of how the currency impacts New York Arabica prices. The other piece is speculators, the hedge funds, different funds that are trading this market. You know, historically, the R squared, the correlation on when Hayal and moves and the impact on prices. And I'm sure they have their black box algorithms that have built that into their trading model. So it's kind of this reinforcing rotation or circle, I guess, where the Hayal may strengthen. So then you get specs buying, and then you get the lack of selling. So it's kind of this self-fulfilling move
Yeah.
on the currency.
So we've covered a couple of these. So we also touched on large speculators. In all, I mean, it's just good to know that there are numerous variables that are affecting the market and creating price volatility. So you can try to, that's why we have people like Josh, who that their whole job is to to figure all of this out and try to make some predictions on what's going on and how to interpret all of this. Oh, sorry, this went a little fast there. So that leads us into the next spot. Josh was going to tell us a little bit about where he sees the market going.
Yeah, so I won't pretend that we know where prices are going to go. I mean, no one has a crystal ball, and no matter how advanced any fund is, or trade house, or algorithm, artificial intelligence, there's plenty of them. No machine, no person can call this market. But having said that, we can have a bias on where prices are going to go. We put out a monthly report to our clients. Let us know if you're interested. We can probably put something together for Novus clients as well. But we put together a price forecast, and obviously we're not going to be right all of the time. This is just our genuine bias, and we're not. I wouldn't say this is what we truly believe. So at least for the month of June, when we put this out here, we said, okay, prices can range from 88 cents to $1.01. For July, August, 92 to 118, and then SEP, OCNAV, 94 to 130. And I know someone may look at this and say, wow, those ranges are really wide. You're not really putting your foot down, so to speak. I think the takeaway here is directionally, we think prices are going to move higher. And if you kind of look at the midpoints, so July, August, you can say 105 is the midpoint there. And again, we were at 96 today. And then for SEP OCNAV, the midpoint is about 112. So if we see a high low of 130 to 94, midpoint of 112, that kind of how I would read this. This is just looking at that range and say, wow, that range is so wide.
Is it?
The other thing is,
I was just going to ask, is it true? It looks like the further out you go, the range gets wider. Is that kind of a general rule? Like the further out we go, we have less kind of security or whatever in what we think is going to happen.
Yes. The further out you go, the wider the ranges. And the options markets are mathematically, I guess you could say, beautiful, in that these ranges are really based on where the option markets are dictating where the ranges will be. I don't want to get too technical, but you could buy calls and buy puts, and then if it was a no-brainer that prices are going to go much higher or much lower, everyone would make money. We would just all buy calls and buy puts. All we needed to do is to break out either higher or lower. We're all going to make money. So these ranges are really based on the options market and what that costs to buy a call and a put. And the market is telling us, so we're kind of backing into these ranges based on what the options are mathematically telling us. where anyone can go buy it. So if someone were to take that long, it's called a long straddle, where you buy a call, buy a put, that means if I do it in, I guess, for the September, October, November period, in order for me to make money, it's got to go above, let's say, 130. And then for me to make money on the downside, it has to go below 94 cents. So that kind of gives us the range. So it's not a range that we just came up with. It's something that the market is really giving us. And then we provide our directional bias. We'll move it up or down based on what we'll show in the next slide. But that's kind of the reverse engineering on those price ranges.
Awesome. So I'm gonna let you take this slide, give a little context to it.
Okay. So if someone asks, okay, fine, I get it. Directionally, you think prices are going to move higher from where we are. I mean, and I will say that we actually think in the short term, we could go lower. There's a very good possibility we could go to 90 cents or 88 cents. But as we look longer term, we should transition higher. These four charts kind of provide the rationale as to why. The top left is the chart just on certified stocks. So this is the inventory of coffee where if someone were to buy futures and they want to take delivery of that coffee after first notice date, it would get pulled from this inventory. So this is the certified stock inventory number is highly watched. It's tracked, and this is basic fundamentals where this certified stock number just keeps getting lower and lower and lower. It's supply and demand. Or if it gets too low, then prices should go higher, theoretically. The important thing here is where differentials are of washed Arabicas, not anywhere close to tenderable parity is what they call it. So at least for the next year, at least, we're not going to see a big onslaught of coffee that's being harvested, sent to the board. And that's what's most important is what are we forecasting, what's going to happen, and we think it's going to continue to erode. And with coffee under $1, it's historically very cheap, and an erosion of this inventory, it just creates what's called a bullish scenario where we think prices will come back. Another interesting chart is on the top right. It's the seasonality. So this is just looking at the last 8 years from 2012 to 2019. And if you just do a statistical model of every year and what's the price behavior if January 1st is your starting point, the low point of the year is statistically mid-June. And it goes to that old adage to sell in May, go away. And that's in equities, it's in other markets as well. And statistically, it works. Doesn't mean it's going to work every year. You're going to have years where prices may do the opposite, the counter-seasonal move. But if you're taking an average of the last 10 years, 15, 20 years, this is the price behavior of coffee, where you get that low period around June. But then conversely, that's typically a good buy, where that's the low of the year. So mid-June, July, you start trending higher and you start moving higher for the rest of the year. So it's not, again, nothing is fail-safe, or else we'd all be millionaires. But if we just look at the statistical averages, that's the price behavior of coffee futures.
Okay, so we can kind of draw from that June, typically year over year, June tends to have a lower price on the market.
Yes.
Awesome. And yeah, go ahead.
Sorry. So the chart on the bottom left, we talked about this, the Brazilian real against the US dollar. We recently saw it get to the lowest historical level we've ever seen. This is after COVID, or in the midst of COVID. So it makes sense that prices are below $1. But where do we go from here? It still remains to be seen whether it's gonna go lower, and an argument could be made that it should go lower because Brazil is one of the countries that did very little in terms of quarantining or any COVID prevention mandates by the government. So it's a scary situation over there. But the flip side of that, without getting too complicated, is COVID does get worse and worse. Now it's a supply chain risk where Brazilian coffee being exported it may go through some hurdles. And we actually saw a situation last month where one of the soybean ports was shut down temporarily, and that could be bullish. So that's one of the concerns for coffee in Brazil.
Okay. And your last one here?
The last one is the arbitrage, and I'm sorry, this gets a little technical, but the arbitrage is just the difference between Arabica futures minus Robusta futures. And it's a good indication for, because it's very much range bound. It can get to high levels where it's resistant, and then it comes down, and then it bases, and then that's typically a good purchase for futures. And it's this interrelationship between Arabica and Robusta. Arabica is viewed as much better quality, so it should be more expensive than Robusta. But once those prices get too close, then you have mainstream roasters who may switch out of Robusta and buy Arabica to a higher blend or higher quality blend, and then that.
Right.
So it's this interrelationship that it's a very useful variable when trying to forecast prices. What is Arabica doing relative to their little sibling Robusta?
Awesome. Thank you for explaining that. So
Sure.
we've talked about so many different things, and we've looked at you know, all of this that's going on a very large scale. Is very kind of a real like macro situation with what's happening and how these funds are moving. And I wanted to bring it down into something a little bit more basic, so we can talk a little bit about how we can help small producers to minimize the risk and exposure to market volatility. Because our small producers that we love are not the ones who are going in and hedging their production, right? So, whoops, oh man, see if I can go back. So one of the things that Mercon has developed is a really interesting program called Lift, and Lift is a education and program that provides the tools for to empower small producers to improve the yield on their farms, to improve their financial sustainability, to have greater access to capital, and to really improve the agronomy that's happening on their farm, improve the quality levels, and in turn go ahead and help to raise what they're getting from the farms, raise what they're able to sell their coffee for. So Lift is a really interesting way of trying to help producers to reduce to help reduce risk that comes with growing coffee. When you have such a volatile market and the market's moving all over the place, it's really important to think about the sustainability of the farm and how we can provide tools that allow farmers to insulate themselves from some of that volatility. So a producer might go ahead and in a traditional way, they can secure lending to pay the costs of production expenses for the upcoming year, including fertilizer, labor, equipment. That lending is secured through future sales and requires some sort of price protection. And then those futures can be sold to ensure profitability if the price declines. But that has to be done on a large scale, which may leave out some smallholder farms and makes them very vulnerable to the swings of the market. On a different perspective, through the Lift program, and just as note, Lift is a grassroots sort of program that Mercon started. Mercon's based in Nicaragua, and there's a lot of work on the ground with farmers there. And so really hearing what farmers needed We have lift in Nicaragua as well as Guatemala, Vietnam, Brazil, Honduras, and soon to be Ethiopia as well. Each lift program is basically the same as far as the tools that are used, but may have a little bit of a different emphasis. So for instance, in Vietnam, they're able to emphasize quality, right, to bring up the quality level of Arabica that's picked. Whereas in Honduras, the emphasis might be really heavily on agronomy in order to improve yield and improve quality, especially on the farms. So by taking a hands-on approach and looking at each farm in each region very individually with what's needed on the ground, Lift kind of takes a different approach. So through Lift, a farmer might have additional access to finance and capital programs, programs that directly exchange production inputs for future harvests. So that's one of the great things, and those are very competitive with other ways that somebody might be able to secure capital. There's also agronomy assistance, which improves yield, as I mentioned, and reduces the cost of production for the farmer. Mercon also guarantees the purchase, can guarantee up to the purchase of a full crop from a farmer if they want to sell. It's a really great way for a farmer to kind of take that to the bank and say, this is sold, it's sold at this price, and I know how much I'm going to be getting for this coffee. Farms of all sizes in these little clusters where Lift is used in the countries that the program is operational, the farms are of all different sizes, all different sorts of ownership, and they all have access to these same services. Josh, I know you've had a little bit more experience working with Lift. Would you mind giving us your opinion on the Lift program, just real briefly?
Yeah, absolutely. I mean, I've been in coffee for a long time, and I may be biased, but I think this program is best in class in the entire industry as far as sustainability goes. The backbone of the program, so studies have shown the best way, one of the best ways, if not the best way to help farmers, empower farmers, is through agronomy training. And the reason goes to the old adage, you don't give a man or a woman a fish, you teach them how to fish. So it's much more effective for our world-class team of agronomists to teach them best practices so that they can increase their production yields. So on average, the KPI is their yields are, after they go through the program, are 48% higher than the national average in Nicaragua, which is just higher income. And it's not some kind of check that you give to producers every year. It's training, world-class training that they have for generations. And that increase in yield is just sustainable naturally over years, which means their incomes have increased, have jumped significantly because the quality has improved, the production has improved, and it's been a very effective and empowering program for the producers. And not only just the training, but also the financing to help them with the cash flow, treating their farm as a business, that type of training, all the latest technology with the apps, as well as now we're instituting price protection tools. So whereas put options, downside protection may it previously been limited to just high multinational trade houses, now we're trying to offer those price protection tools to the farmers if they elect to do so. So it's just a really good project, really good program. A lot of clients like it. They like the close relationship where they can choose a region, they can support that region, they can get the coffee from that region, they can visit that region. And it's a good adjacency with our other foundation, Seeds for Progress, where we have schools in these coffee farming regions and we support them. And we've been doing all these things before the word sustainability was even invented. It's just kind of in the DNA of Mercon as a company. And we're thrilled that it's now gone mainstream, but this is something that the employees at Mercon are really passionate about. And I think more and more roasters want to do things that have a higher touch point than just buying a certified coffee. And I'm not bashing certified coffee, that we all have our place in sustainability, but this is a more high touch point, and you see your KPIs, you see where your investment dollars go. And I can't say enough about Lyft.
Also, the coffees that come off of Lyft farms are really amazing. Just like in a very basic like quality level,
Mm-hmm.
they're phenomenal. So if anybody who's listening is interested in learning more about Lyft, shoot me an email. If you'd like to go, when all of this kind of craziness calms down, and you'd actually like to go and visit a Lyft farm and hear from a farmer about what that sort of program looks like and how it works on their farm, shoot me an email on that as well. We're hoping to take some people down as soon as things kind of clear up. But I think it's a really interesting way to look at trying to protect farmers from kind of insulating them by making the farms very sustainable. Many of when best practices with agronomy are used and yield goes up, what you end up seeing is the cost of production goes down. So we're able to make farms more profitable by offering the tools to help the farms run, produce a better quality and run more efficiently. All right, so that brings me to the end. I want to thank everybody for sticking with me through all of this kind of complicated stuff. If I know that we've gone over our time by just a little bit, I'm going to go ahead and I haven't looked at the chat to see what kind of questions we have. But we'll do a quick look through in the chat. If you've got to go, I totally understand. Thank you so much. I'll be following up by sending everybody a really quick survey to see how you enjoyed the class or the webinar, and how we can offer additional classes and webinars for you that add value and help you to grow as a coffee professional. So just want to thank the team at Novus for all of the help and support. And absolutely, of course, Joshua with Mercon, the whole Mercon team. There are so many people that I have reached out to over the last few weeks to pick their brains and try to understand things better. For all of you coffee roasters who struggle through some of this content, the whole thing with the market is it's complex, and it takes a long time to kind of figure it out. But I just want to let you know that we're here to help answer questions for you, and we're here to help provide any sort of support that we can. Feel free to send me questions. If I can't answer them, I know exactly who to go to get your questions answered. And I just also want to mention our program at Lyft and thank the team at Lyft in Nicaragua who helped by providing additional information and context for this presentation. So, okay, I'm going to stop my screen share, check into the chat. Okay, so we do have a couple of questions that that have come in. Oh, maybe not quite. I think there's a kind of technical one for Joshua, and I'll just read it for you, Joshua. It may be a little bit more than I can follow along with. It says, Josh, what studies do you use in your technical analysis? RSI, moving averages?
Yeah, I have to be careful what I say because some of this is proprietary. But yes, we look at everything: stochastics, RSI, moving averages, chart patterns. There's a couple guys on our team that have been doing technical analysis for a couple decades. Technical analysis is really important in the coffee market because the large speculators use technicals very much so, and it helps dictate their buying and selling behavior. So as an industry, we were almost forced to be educated on technical analysis because those large specs who move the market use technicals so much in their trading. So yes, maybe someday we'll do some kind of technical analysis webinar. But
I
yeah, we
have.
look at everything under the sun. You have no idea. It's just your head will explode if I get
Well,
into it.
I've been completely amazed that I get a daily weather report from Brazil that gets sent into my email, and it's while it does not affect what I'm doing at all. It is really really cool to know that people like you are actually paying attention to what the weather's looking like today in Brazil, and the lunar cycles. Who knew that lunar cycle
Yeah.
and when there's a full moon was so influential in coffee in Brazil. So I haven't seen any astrology charts yet, so maybe that's something to look into.
It's really interesting. So the one thing that can just make the coffee market explode higher is a major frost in Brazil. And we haven't had one since a major frost, probably 1994 or 97. It's been a long time. But if we do get a frost, we'll see $2 coffee pretty easily, depending on how widespread it is. I think the reason why we haven't seen a frost in Sul de Minas, which is the major growing region, is because over time they've navigated north, closer to the equator, so to mitigate some of that frost risk. But I mean, we know the weather nowadays. It's so erratic. We're seeing things that we've never seen before. And it's funny you mentioned lunar cycles, because one of our guys who follows meteorology very closely has identified there's a decadal rotation in terms of sunspot activity. And 2020 is the year of the decadal low of sunspot activity, which is correlated to the increased chance of frost in Brazil. So we have our
Which
antennas
is
up.
why people should listen to you about what's going on, because who would know that? Who would know about sunspots?
Yeah, it's crazy.
So just to let everybody know, I'm gonna go ahead and end everything. Thank you guys all so much for joining and for being part of this. It's just wonderful to see so many people and see so much interest. So thank you very much from the entire team of Novus. Lots of thanks and appreciation. I will be sending out an email within the next 10 minutes that's going to have a survey on it. While the experience is fresh in your mind, I would love it if you would fill out the survey and provide Joshua and I with some feedback about how the webinar went. And there will also be a spot that's going to allow you to request additional information from either Mercon, Lyft, or Novus. So definitely use that to correspond with us. And just want to thank everybody again. And I hope you guys all have a wonderful Juneteenth. Enjoy, have a great day, and eat lots of barbecue. Okay,
All
bye.
right. Take care.
Bye. Thank you.
Thank you.